Hi everybody, it's me again. In our last class, I was asked to prepare a video to go over and summarize how I would have how we would have reviewed, done the review for final, and I was asked to prepare a video and do that so you can watch it. And one of the things, so I'm going to go through here chapters 1 through 14. And talk about the main things that you should know and understand to get ready for this final. Remember, the final will be true and false and multiple choice. It's about concepts. But chapter 1 talks about the goal of managerial accounting. You need to understand the difference between managerial accounting and regular outside financial accounting. Planning for budgets and planning, then there's planning for budgeting for planning, control, performance reports, decision making. And then we get into different costs, concepts called variable costs, fixed costs, sunk costs, opportunity costs, direct and indirect costs, controllable and non-controllable costs. Those are things that we should know. And then we have the impact of technology on management, especially the value chain where the information is shared with suppliers. And information gets back and forth, so it just speeds up the flow of supplies into a company. Chapter 2 is about job order costing. So you need to understand the difference between job order costing and process costing. Chapter 2 is job order costing, and there's a thing called manufacturing costs, direct labor, manufacturing overhead, selling costs. These are non-manufacturing costs. Selling costs, they're also in general administrative costs. They're also period costs. You need to understand the difference between period costs and product cost. And then know what a cost of goods manufactured statement is, cost of goods sold, how that's all calculated, direct material costs, direct labor costs, and then manufacturing overhead. Those are the things in Chapter 2 that are important. Chapter 3 is process cost accounting. It's quite different than job order cost accounting. And so it's important to understand it. Product flows through departments. Cost flows through accounts. Direct material, direct labor, and manufacturing overhead, transferred in costs. Then there's a thing called calculating equivalent units, cost per equivalent units. And then you have costs transferred out and how you determine those costs. Ending work in process. Then you have a thing called reconciliation of units. The units go into the process, the units come out of it, have to be reconciled. The costs that go into the system, the manufacturing process, have to be reconciled with the costs that go out. So that's Chapter 3. Chapter 4, cost, volume, profit analysis. Again, we get into the determination of variable cost, fixed cost, mixed cost, step costs. So we come up with different methods to determine fixed and variable costs. And one is account analysis. Just what that is that. Scatter graphs, a high-low method, regression analysis. And then there's this thing called the profit equation, which there's a break-even point we can calculate from that. What is contribution margin? Are units needed to achieve a target? What's the contribution margin ratio? You can play what if with those kinds of things. We can play what if analysis. Okay, Chapter 5 is variable costing. And you need to understand the full absorption and variable costing concepts. What is variable costing? Income statement. And how does it differ from full cost? Remember, in full cost, the fixed cost in overhead goes into the cost of goods sold, and so at the end of the period, if we produce more than we sell, then we've got more costs in the ending inventory in a full costing method than in a variable costing. So when the quantity produced is equal to the quantity sold, the bottom line, the net income for a full costing statement is the same as it is for a variable costing statement. When we produce more than we sell, then because there's more fixed cost in ending inventory under a full costing method, This profit is greater with the full costing system than it is with the variable costing system. So I need to understand how that happens and why that is. Chapter 6, cost allocation of indirect costs, and then also a concept called activity-based costing. And we need to allocate, businesses need to allocate indirect costs for decision making to make sure they can keep track of every cost and reduce frivolous use of common resources to provide full cost information for the operation. So one of the things we have to do with an overhead is we have to select the cost, determine the cost objective, forming a cost pool, and select a method of allocation. And there's a direct method of allocating services, product services. Then it talks about activity-based costing. We need to understand that. It's really more costly. It breaks the cost down into a lot more cost centers, and so it's a more refined allocation of activity-based costing, and it actually ends up being more accurate determination of the costs. I hope I haven't stumbled through that too badly. Chapter 7, the use of cost information in management decision making. This is an interesting chapter, I thought. You come up with additional processing decisions, make or buy decisions, dropping a product line decisions, and then also it says beware of the cost spiral, and that's to do with a cost plus contract or cost plus way of calculating costs. And then we get into the allocation of joint costs, the additional processing decisions of joint costs, and so forth. Chapter 8, which is pricing decisions and profitability analysis. And then we got into this profitability maximizing profit maximizing price. What price gives us the best bang for the buck? And you remember we go through and ask our marketing personnel to tell us how many units can be sold at different prices. And we use those, put those in a spreadsheet to come up with the price that makes the most profit for us. And then there's special pricing of orders, cost plus pricing. Target costing, I thought, was a very interesting one. And then there's activity-based pricing for customers, because some customers are more profitable than others. Chapter 9, capital budget. This was a very important. Capital budgeting is critical for a company. We talked about what a capital budgeting is, and how do we evaluate it. And to evaluate a capital budget, we use such concepts as basic time value of money calculations, the net present value method, the internal rate of return, and we've talked about how depreciation and taxes can impact the cash flow, because these evaluations are all made on the basis of cash flows. Okay, I think that's basically what we talked about in that chapter. Chapter 10, budgetary planning for control. We spent a lot of time going through this one. You have sales budget, production budget, direct material purchases budget, direct labor budget, manufacturing overhead budget, selling and administration expense budgets, budget income, capital acquisition budget, and then we have a cash flow budget. And then from there we can also have a budget balance sheet. So those are important to go through. Then chapter 11 is the standard cost, variance analysis. What are standard costs and how are they developed is something we need to know. And so we come up with the development of standard costs, and the basic we come out of there is variances. We compare there's material variances, there's a material price variance, and a material quantity variance. Then there's labor. There's a labor rate variance, and an efficiency variance, a labor efficiency variance. Overhead variances. There's a controllable overhead variance, which is there's detailed analysis of controllable overhead, and then overhead volume variance. So anyway, those are things those are variances are important that we can work on. Chapter 12, decentralization and performance evaluations. We talked about the advantages and the disadvantages of decentralizations. And we evaluate units and evaluate subunit managers. Talked about cost centers, and profit centers, and investment centers, and how we measure each of those. And this concept of return on investment. We talked about coming up with a concept called the economic value added, EVA, and how that gets calculated, the residual income, and how important it is for that, and that measurement of those. Chapter 13 is, we didn't do chapter 13, we did chapter 14. And chapter 14 is why managers analyze statements. And in that we talked about horizontal and vertical analysis of statements. We talked about different ratios, profitability ratios, turnover ratios, debt-related ratios, and all those things are important. And we talked about that. One thing that I would like to point out, in each of the chapters, there is a self-assessment, and the answers are there, but there's about 10, 12 questions. They're multiple choice questions, and they're very good, and each chapter has got one. My suggestion to you is that you go through each of those in each chapter, and it will help you to get ready for this exam. I look forward to seeing you and meeting with you at the time of exam, and hope you all do well. Thank you.